Welcome to your deep dive into life insurance.
Oh, yeah.
We're about to unpack a stack of information from what looks like a Canadian life insurance textbook, perfect for building a solid understanding from the ground up.
Yeah.
And we're not just skimming the surface here.
Yeah.
You'll get the inside scoop on how policies actually work,
Right.
what to watch out for, and even the tax stuff that most people don't even realize they need to know.
Yeah. It's fascinating how often people think life insurance is just about
Oh, yeah.
what happens after you're gone. But really, it's a powerful tool for managing risk.
Right.
Don't you?
Okay, so how does that work exactly? I mean, we're not talking about avoiding a meteor strike, are we?
Not quite. But there are four main ways to deal with risk: avoidance, reduction, retention, and transfer.
Okay.
Life insurance is all about risk transfer.
All right.
Instead of bearing the potential financial burden of an unexpected loss yourself, you're shifting that risk to the insurance company.
Right.
They take it on in exchange for your premiums. And if the unthinkable happens, they step in to provide financial support.
So it's like having a financial safety net.
Yeah.
But how do you even begin to figure out what kind of coverage you need? And what about all the different types of policies? It can feel overwhelming.
Yeah, for sure. Before we jump into the different types,
Okay.
it's important to understand the key players involved.
Okay.
You've got the policyholder,
Okay.
the one who owns and pays for the policy, the life insured, the person whose life the policy is based on,
Right.
and the beneficiary, the person who receives the death benefit if the life insured passes away.
Okay. So let's say I decide to get a life insurance policy to make sure my partner is financially secure if something happens to me.
Yeah.
I'd be both the policyholder and the life insured,
Yes.
and my partner would be the beneficiary, right?
Exactly. You're paying for the policy, and it's based on your life. If something happens to you,
Right.
your partner would receive the death benefit.
But what if my company takes out a policy on me to protect themselves from losing a key employee?
That's a great example of how the roles can be different.
Okay.
In that case, you'd still be the life insured,
Right.
but your company would be both the policyholder
Okay.
and the beneficiary.
Oh, wow.
Interesting, right?
So it's not always as straightforward as it seems.
Yeah.
Now let's talk about the two main types of life insurance: term and permanent. It's like choosing between renting and owning right.
That's a great analogy. Term insurance is like renting coverage for a specific period, say 10, 20, or 30 years.
Okay.
It's often more affordable up front,
Right.
but there's no cash value buildup.
Okay.
Once the term ends, the coverage expires.
So it's good for temporary needs like covering a mortgage or providing financial support until your kids are grown.
Exactly. Now, within term insurance,
Okay.
there are actually several variations that can be tailored to your specific circumstances.
Okay.
You've got single life, which covers one person, joint first to die, which covers two people and pays out when the first one dies, and joint last to die, which pays out when the second person dies.
Wow, so many options. But why would someone choose a joint policy?
Well, imagine a couple who adopts a child.
Right.
A joint first to die policy could ensure their child's financial security,
Right.
no matter which parent passes away first.
Okay.
And if one parent passes away, the surviving parent can often continue the coverage
Oh, wow.
without needing a new medical exam.
Okay.
That can be crucial if their health has changed.
Right.
And getting new individual insurance would be difficult.
That's a good point.
Yeah.
And I remember reading about convertible term insurance. How
Right.
does that work?
Convertible term is like having a safety net for future health changes.
Right.
Let's say you're worried about a health condition that runs in your family
Right.
and might affect your insurability down the road. You can get a convertible term policy now.
Okay.
And if you develop that condition later on,
Yeah.
you can convert it to permanent coverage without needing a new medical exam.
So you're essentially locking in lifetime protection,
Yes.
even if you become uninsurable later.
Exactly.
That's pretty smart.
Yeah.
But what about this contestability period I've heard about? That sounds a little scary.
The contestability period is a standard feature of most life insurance policies.
Okay.
It's typically the first 2 years of the policy. And during this time, the insurance company has the right to investigate the information you provided on your application.
So they're making sure I didn't try to pull a fast one.
Essentially, yes.
Right.
They're looking for any inconsistencies or misrepresentations
Yeah.
that might affect your insurability.
Okay.
If they find something significant, they could deny a claim.
That makes sense.
Mm-hmm.
But how strict are they really? I mean, what if I forgot to mention a minor doctor's visit from years ago?
It's always best to err on the side of caution.
Right.
And disclose everything,
Okay.
even if you think it's insignificant. Even seemingly small omissions can have big consequences.
Okay, so honesty is definitely the best policy when it comes to life insurance applications. Now let's switch gears and talk about permanent life insurance. This is the own it, not rented option.
Exactly. Permanent life insurance, as the name suggests, is designed to provide lifelong coverage.
Okay.
It's more expensive up front than term insurance,
Right.
but it comes with a key advantage: cash value buildup.
So it's like having a savings account built into your insurance policy.
Yeah.
That's pretty cool.
Yeah.
But what are the different types of permanent insurance?
There are three main types: whole life, term 100, and universal life.
Okay.
Whole life is often considered the classic type of permanent insurance.
Right.
It typically comes with level premiums and guarantees both a death benefit and cash value growth.
That sounds pretty straightforward.
Yeah.
But I've heard that even with whole life, there can be some variations.
Sure.
What's the deal with participating and non-participating policies?
That's a great question. A participating whole life policy allows you to share in the insurance company's profits.
Oh, through dividends.
Okay.
These dividends can be used to reduce your premiums,
Okay.
buy additional coverage, or even be taken as cash.
Wow.
A non-participating policy, on the other hand,
Right.
doesn't offer this dividend feature.
So it's like choosing between a stock that pays dividends and one that doesn't.
Ooh, you could think of it that way. With a participating policy, you have the potential for additional returns,
Right.
but the dividends aren't guaranteed.
That makes sense. Now, what about term 100? Is that like a super long-term
Oh.
policy?
Essentially, yes. Term 100 is designed to provide coverage for your entire life,
Okay.
just like whole life, but with a key difference.
Yeah.
The premiums are fixed for 100 years.
So it's a way to lock in coverage for life without worrying about premium increases as you get older.
Exactly.
Oh.
And for some people, that peace of mind is worth the higher upfront cost.
Now let's talk about universal life, or UL. I've heard it's the most flexible type of permanent insurance. What makes it so special?
UL policies offer a unique combination of transparency and control.
Okay.
Unlike traditional whole life policies,
Yeah.
where the costs are bundled together,
Right.
UL policies let you see exactly what you're paying for. Mortality costs, administrative expenses, and the returns on your investments.
So it's like having a mini investment account within your life insurance policy.
That's a great way to think about it.
Yeah.
And with UL, you typically have more choice
Okay.
when it comes to investments.
Right.
You're not locked into whatever the insurance company decides.
But I've also heard something about a special tax rule called the exempt test. What's that all about?
The exempt test is a key factor in the tax-sheltered nature of UL policies.
Okay.
As long as you stay within certain premium limits set by the government, the investment growth within your policy remains tax-sheltered.
So I can grow my money tax-free. That sounds pretty amazing.
It's a great benefit.
But what happens if I exceed those premium limits?
If you exceed the limits,
Okay.
any excess premiums and their corresponding investment growth could be taxed.
Okay.
It's a complex area.
But the main takeaway is that you need to be mindful of those limits to maximize the tax advantages of a UL policy.
This is all really interesting, but it's a lot to digest.
Yeah,
We've barely scratched the surface of permanent insurance, and there's still so much more to explore.
you're right. We've got a lot more ground to cover, including riders, group life insurance, and the underwriting process.
Oh, wow.
Stay tuned for part 2 of our deep dive,
Okay.
where we'll unravel those mysteries and more.
All right. Welcome back to our deep dive into life insurance. In part 1, we explored the different types of policies, from basic term to the flexible world of universal life. Now, let's say you've got your base policy figured out.
Right.
How can you make it even more powerful, more tailored to your unique needs?
That's where riders and supplementary benefits come in.
Okay.
Think of them like adding superpowers to your life insurance policy.
Okay.
They allow you to customize your coverage to fit your specific circumstances and goals.
So it's like building your own life insurance superhero. That's awesome.
Yeah.
But where do we even start? There seem to be so many options.
Let's start with riders, which provide extra benefits payable upon the death of the life insured. One of the most popular is the paid-up additions, PUA rider.
Okay.
Remember how we talked about PUAs with whole life dividends?
Yeah.
Well, this rider lets you use those dividends to buy additional paid-up whole life coverage.
Okay.
It's a great way to boost your death benefit over time,
Right.
especially if your health changes.
Right.
And you wouldn't qualify for a new policy later on.
So it's like future-proofing your coverage.
Yes.
You're locking in the ability to increase your death benefit even if you become uninsurable later on.
Exactly.
But wouldn't that get expensive?
That's the beauty of using dividends.
Okay.
You're essentially using the insurance company's profits to enhance your own coverage.
Right.
And remember, those dividends aren't guaranteed,
Right.
but they offer the potential for significant growth over time.
That makes sense.
Yeah.
Now, what about those temporary needs that don't require lifelong coverage?
Right.
Is there a rider for that?
Absolutely. The term insurance rider is perfect for situations like covering a mortgage or a business loan.
Oh, right.
You can add it to a permanent policy to provide extra coverage
Right.
for a specific period.
Okay.
And it's generally more cost-effective than buying a separate term policy.
Okay. That seems pretty straightforward.
Yeah.
But what if I'm thinking about starting a family?
Right.
Are there riders that can help with that?
You're in luck.
Oh, good.
The family coverage rider is a game changer for families.
Okay.
It's typically sold in units that cover your spouse and all eligible children.
So it's like a bundle deal for the whole crew.
Exactly.
Okay.
And one of the best features is that as new children are born,
Oh, wow.
they're automatically covered under the rider with no increase in premium.
That's amazing. It takes some of the stress out of planning for a growing family.
Yeah.
But what happens when the kids get older? Do they lose their coverage?
Not necessarily.
All right.
The family coverage rider usually has a conversion option for children,
Okay.
allowing them to convert their term coverage to permanent insurance when they reach a certain age,
Okay.
even if they develop a health condition
Right.
that might make them uninsurable later on. It's like giving them a head start on their own financial security.
That's incredible. It's like a safety net for their future.
Yeah.
Okay. We've covered riders,
Mm-hmm.
but what about those supplementary benefits you mentioned earlier?
Mm-hmm.
Are those only available with permanent policies?
Supplementary benefits can be added to both term and permanent policies,
Okay.
and they provide valuable financial support before death,
Okay.
often during times of serious illness or disability.
So they're like extra layers of protection for unexpected life events.
Exactly.
Okay.
One of the most important supplementary benefits is the terminal illness benefit.
Okay.
This allows you to access a portion of your death benefit while you're still alive if you're diagnosed with a terminal illness.
That makes a lot of sense.
Yeah.
It would give you some financial breathing room during a very difficult time.
Yeah, for sure.
Are there any other benefits that help with those unexpected challenges?
Another crucial one is the waiver of premium for disability.
Okay.
If you become disabled and can't work,
Right.
this benefit kicks in after a waiting period, and the insurance company waives your premiums,
Right.
ensuring your policy stays active even if you can't afford to pay.
That's a huge relief.
Yes.
So what happens to the policy benefits while the premiums are being waived?
Right.
Do they just freeze?
No, that's the best part.
Okay.
Even while premiums are waived, your policy benefits continue to accrue.
Oh, wow.
Dividends still get paid.
Okay.
Cash values may still grow, and other riders remain in effect. It ensures that you don't lose those valuable benefits just because you've hit a rough patch.
That's amazing. It really does feel like a safety net, knowing that you're protected even when life throws you a curveball.
For sure.
Okay, so we've talked about individual policies
Mm-hmm.
and all of the ways you can customize them. But what about group life insurance? How does that work?
Group life insurance is a bit different because it's based on a master contract
Okay.
held by a group or organization,
Okay.
often an employer.
Right.
To be eligible, you usually need to be a member of that specific group.
So like the life insurance I get through my job.
Exactly.
Okay.
And one of the big advantages of group life insurance
Mhm.
is that you typically don't need to go through the same rigorous medical underwriting process
Right.
as you would for an individual policy.
Okay.
This can be a real benefit for
Yeah.
people who might have health conditions
Right.
that make it difficult or expensive to get individual coverage.
That makes sense. But
Yeah.
how do they decide how much coverage you get?
Yeah.
Is it just a random number?
Not at all. Group plans often use different schedules of benefits to determine coverage amounts.
Right.
The most common is the earnings multiple schedule,
Okay.
where your coverage is based on a multiple of your salary.
All right.
For example, if the plan offers a 2x salary benefit and you make $50,000 a year,
Right.
you'd have $100,000 in coverage.
Okay, that's pretty straightforward.
Okay.
But what about other factors like your job title or how long you've been with the company? Do those things matter?
They can. Some group plans use a flat rate for everyone,
Okay.
while others base coverage on length of service,
Mhm.
or even a combination of factors like earnings and position within the company.
So it's not always a one-size-fits-all approach. That's good to know. But what happens if you leave your job? Does your life insurance just disappear?
Not necessarily.
Oh.
Many group plans have a conversion option
Okay.
that allows you to convert your group coverage to an individual policy
Right.
when you leave the group.
Okay.
And the best part is, you usually don't need a new medical exam to do it.
That's a huge relief. But there's got to be a catch, right?
Well, the premiums on a converted policy
Yeah.
might be higher than what you were paying for group coverage,
Okay.
or even higher than a brand new individual policy.
Why is that?
It all comes down to risk.
Yep.
When you convert your group coverage,
Mm-hmm.
the insurance company is taking on more risk
Right.
because they don't have the same underwriting information about you as they would for a new individual policy.
Right.
And to compensate for that increased risk,
Right.
they may charge higher premiums.
So it's a trade-off between convenience and cost.
Mm-hmm.
You're getting the guarantee of coverage
Yeah.
without underwriting, but you might pay a bit more for it.
Exactly. And it's important to remember that group life insurance often comes with additional benefits beyond just the basic death benefit.
Like what?
Things like dependent life coverage,
Okay.
which lets you cover your spouse and children, survivor income benefits, which provide ongoing monthly payments to your beneficiary if you pass away,
Raise.
and accidental death and dismemberment coverage, also known as AD&D.
Wow. Those are some valuable extras. It
Yeah.
really does make group life insurance a comprehensive safety net.
Yay.
But before we get too carried away with all these options, how do we even know if we qualify for coverage in the first place?
Yeah.
That's where underwriting comes in, right?
Yeah, got it.
Okay.
Underwriting is the process
Yeah.
where insurance companies assess your risk and determine your premiums.
Right.
It's like a detective investigation into
Oh.
your health, lifestyle, and financial background.
Okay. This is where it gets a little intimidating.
Yeah.
What are they looking for exactly?
Well, the first thing they consider is your age and gender.
Okay.
Statistically, your risk of death increases as you get older.
Right.
And men generally have a higher risk than women at the same age.
That makes sense. But what about my health history?
Right.
Does every sniffle and sneeze count against me?
They'll definitely look at your medical records
Okay.
for any pre-existing conditions or red flags
All right.
that might affect your insurability.
Okay.
But it's not just about your past. They're also interested in your current lifestyle and habits.
So if I'm a chain smoker with a penchant for bungee jumping, I'm probably going to pay more for life insurance.
It's likely yes. Underwriters take things like smoking,
Right.
drinking, driving record, and even your hobbies into account when assessing your risk.
Okay, so honesty is key.
Mm-hmm.
Trying to hide my skydiving habit won't do me any favors in the long run.
Exactly. And there's a fascinating organization
Wonder.
that plays a role in the underwriting process.
Okay.
The Medical Information Bureau, or MIB.
Okay.
Think of it like a central database for insurance companies.
Wait, so they're keeping tabs on all my medical mishaps? That sounds a little Big Brother-ish.
Not exactly. They're not tracking every doctor's visit.
Okay.
But when you apply for life insurance,
Hmm.
you authorize the insurance company to check the MIB database for any pre-existing conditions or red flags that might affect your insurability.
So it's more like a background check for my health.
You could think of it that way.
Okay.
And it helps insurance companies make more informed decisions about risk and pricing.
Okay, so I can't really hide from my medical past when it comes to insurance.
Yeah.
But what about my finances? Do they scrutinize those too?
Yes, financial information is also important.
Okay.
Underwriters want to make sure that you have an insurable interest in the person you're insuring.
Right.
This means you would suffer a genuine financial loss
Okay.
if they passed away.
That makes sense. You wouldn't want someone taking out a policy on a stranger
Right.
just to collect a payout.
Exactly. It's about protecting legitimate financial risks,
Right.
not speculating on someone's life.
Okay, so they've gathered all this information about me, my health, my habits, my finances. What do they do with it?
Based on their assessment, the underwriter will assign you to a specific risk class:
Okay.
standard, preferred, or rated. A lower risk class usually means lower premiums,
Right.
while a higher risk class could mean higher premiums or even a decline in coverage.
So it's like being sorted into different categories based on how risky I am to insure?
You could say that.
Okay.
And your risk class, along with the type and amount of coverage you choose, determines your premiums.
Okay, so let's say I've made it through the underwriting gauntlet and I'm ready to sign on the dotted line. Is that it? Am I done?
Not so fast.
Oh.
Before you finalize your policy, it's crucial to carefully review the contract.
Okay.
And make sure you understand all the terms and conditions.
Okay.
Pay special attention to the grace period,
Okay.
the incontestability clause, and the suicide exclusion provisions.
Right. I have to admit those sound a little scary. What are those all about?
The grace period is a set amount of time,
Okay.
usually 30 days after your premium due date, during which you can still pay without your policy lapsing.
Okay.
The incontestability clause means that after a certain period, usually 2 years, the insurance company can't contest the validity of your policy,
Right.
even if they discover something you didn't disclose on your application.
Okay.
And the suicide exclusion provision
Right.
typically states that if the life insured dies by suicide within the first 2 years of the policy,
Yeah.
the death benefit won't be paid.
Wow. That's a lot to think about. It really highlights the importance of understanding those legal details.
Yeah, definitely.
But we've been talking about all these different types of policies and features.
Right.
And I'm still wondering, how much life insurance do I actually need?
That's a great question.
Yeah.
And that's where a needs analysis comes in.
Okay.
It's about assessing your specific financial obligations,
Okay.
goals, and the potential impact of an unexpected loss.
Okay, so how does that work? Do I just pull a random number out of a hat?
Not quite.
Okay.
There are two main approaches to a needs analysis:
Okay.
income replacement and capital needs. The income replacement approach looks at how much money would be needed to replace your income if you were to pass away,
Right.
ensuring your family can maintain their lifestyle
Right.
and achieve their long-term goals.
So it's not just about covering the bills, it's about making sure my family can continue living comfortably and achieving their dreams, even if I'm not there.
Exactly. And it's important to consider all the potential expenses,
Right.
including things like childcare, education costs,
Yeah.
and even the value of a stay-at-home parent's contributions.
That's a really good point. It's easy to overlook those non-salary contributions.
Yeah.
Now, what about the capital needs approach?
The capital needs approach focuses on lump sum expenses that would need to be covered upon death,
Right.
like outstanding debts, funeral costs,
Right.
potential estate taxes, or even leaving a specific inheritance.
So it's about making sure those big financial obligations are taken care of.
Exactly.
Okay.
And it can also be about reflecting your values and priorities. Maybe you want to leave a donation to your favorite charity, or ensure your children's education is fully funded.
This is all starting to make sense.
Mm.
But there's one big piece of the puzzle we haven't talked about yet. Taxes.
Ah, yes. Taxes are often overlooked when it comes to life insurance,
Right.
but they play a significant role. Join us in part 3 as we unpack the complex world of tax implications and learn about managing existing policies.
Welcome back to the final part of our deep dive into life insurance. We've covered a lot of ground for the different types of policies and riders, to the ins and outs of underwriting, but we've saved one of the most important
Right.
and often misunderstood topics for last: tax implications.
Yeah.
I have to admit,
Yeah.
this is the part that always makes my eyes glaze over a little.
It's understandable. Taxes can be a bit daunting,
Right.
but when it comes to life insurance, understanding the tax implications can save you a lot of headaches and potentially a lot of money.
Okay, I'm all ears. What are the key things I need to know?
The first thing to remember is that the death benefit
Okay.
from a personally held life insurance policy is generally tax-free in Canada.
Oh,
This is a huge advantage,
right.
regardless of what type of policy you have or
Yep.
how long you've had it.
That's great news.
Hmm.
So my beneficiaries won't get hit with a massive tax bill when they receive the death benefit. But what about the cash value that builds up inside a permanent policy?
Right.
Is that taxed differently?
That's where things get a little more complex.
Okay.
While the death benefit is tax-free,
Right.
any gains you make from cashing in or withdrawing from your policy while you're alive could be subject to taxes.
Okay, so it's not a completely free ride.
Mm-hmm.
When would those taxes come into play?
Anytime you make a policy disposition, essentially any action that involves taking money out of your policy before death
Right.
could trigger a taxable event.
So things like surrendering the policy for cash,
Yeah,
taking out a loan against the cash value, or making a withdrawal from the investment account.
exactly. Each of those actions is considered a deemed disposition,
Okay.
which means you're essentially considered to have sold a portion of your policy.
And how do they determine how much of that gain is taxable? It seems like there would be a lot of moving parts to track.
You're right. It's not always a simple calculation.
Right.
To figure out your taxable gain, you need to understand your policy's adjusted cost basis, or ACB.
Okay.
This is basically the total of all your premiums paid minus any dividends or withdrawals you've already received.
It's like keeping track of all the money you've put in
Yeah,
and taken out over the life of the policy.
exactly.
Okay.
And any amount you receive that exceeds your ACB is considered a gain.
Right.
And that gain could be taxable as income.
This is starting to make sense, but it's definitely a lot to keep track of. Is there anything else that can affect the tax implications?
Yes, the generation of your policy can also play a role.
Okay.
Policies issued before 1990 are considered G1 policies,
Right.
and they have different tax rules.
Okay. Then G2 and G3 policies,
Okay.
which were issued after 1990.
Why do they have different rules? It seems like things would be simpler if all policies were treated the same way.
Well, tax laws are constantly evolving.
Right.
And the rules surrounding life insurance have changed over time. G1 policies were issued under a different tax regime,
Okay.
and they've been grandfathered in under those old rules.
Okay. So it's important to know what generation your policy falls under, but how does that actually affect the taxes?
One of the key differences is that G1 policies aren't subject to the exempt test,
Okay.
a rule that determines how much of your policy's investment growth
Right.
remains tax sheltered. G2 and G3 policies, on the other hand,
Okay.
do need to pass this test to maintain their tax advantage status.
So the exempt test is like a hurdle that newer policies have to clear
Exactly.
to keep their tax benefits.
And it can get quite complex with a
Wow.
lot of specific rules and calculations involved.
But the main takeaway is that if your G2 or G3 policy fails the exempt test, a portion of your investment gains could become taxable.
This has definitely reminded me why I usually avoid thinking about taxes. But it's good to know the basics, even if I'll probably need a professional to help me navigate the details. Now, what about transferring ownership of a policy? Let's say I want to give my policy to a family member or even donate it to a charity. What happens then?
That's a great question. When you transfer ownership of a policy, it's called an absolute assignment.
Okay.
And yes, there can be tax implications depending on who you're transferring it to.
So it's not as simple as just signing the policy over to someone else?
Unfortunately, no. If you transfer your policy to someone who's not at arm's length,
Okay.
meaning someone you have a close relationship with, like a sibling or a business partner,
Right.
the transfer could be considered a disposition,
Okay.
and you might have to pay taxes on any gains.
Okay, so I need to be careful about who I give my policy to. What if I want to give it to my spouse? Surely there's no tax on that, right?
You're in luck. Transferring a policy to your spouse is generally considered a rollover,
Oh, great.
which means there's no immediate tax hit.
Yep.
Your spouse inherits the policy with the same adjusted cost basis that you had,
Okay.
and any future gains will be taxed when they dispose of the policy.
That's a relief. It's good to know there are some tax breaks when it comes to spouses. But what about transferring a policy to a child or grandchild? Wouldn't that be a great way to help them financially?
It can be, but you need to be aware of potential income attribution rules.
Okay.
If you transfer a policy to a child who's under 18, any future gains on the policy could be attributed back to you for TANF purposes.
So it's like the government is saying, nice try, but we're still going to tax you on those gains.
Essentially, yes.
Okay.
It's a way to prevent people from using life insurance policies
Right.
to shift income to lower taxed family members.
Okay, so there are definitely some complexities when it comes to transferring policies.
Yeah.
But what happens to my life insurance when I pass away?
If you die while owning a life insurance policy on someone else,
Right.
your estate is generally deemed to have disposed of that policy.
So it's like the policy is being sold, even though I'm not around to do it.
That's right. And if there's a gain on the policy,
Okay.
meaning the death benefit exceeds your adjusted cost basis,
Right.
your estate could be taxed on that gain.
Okay, so even death doesn't necessarily escape the tax man. But what if I want to avoid those taxes and do something good with my policy? Can I donate it to charity?
Absolutely.
Oh, good.
Donating a life insurance policy to a registered charity can offer some significant tax benefits.
Okay.
You can get a tax receipt for the fair market value of the policy,
Okay.
and you can potentially offset any capital gains that might arise from the transfer.
So it's a win-win. The charity gets a valuable asset, and I get a tax break. That's fantastic. Okay. We've covered a lot of ground on taxes, and it's clear that it's an area where professional advice is essential.
For sure.
But what about managing existing policies? Life is full of changes, and I imagine my insurance needs might change right along with it.
You're absolutely right. Life is constantly evolving,
Right.
and your insurance coverage should evolve with it. Regular reviews
Right.
are crucial to make sure your policies are still aligned with your needs and goals.
How often should I be reviewing my policies? Annually.
It's a good idea to review them at least every 3 to 5 years.
Okay.
Or whenever you experience a major life event,
Right.
like getting married, having a child, buying a house, or starting a business.
That makes sense.
Yeah.
But what if I need to make changes to my policy?
Sure.
Is that a complicated process?
It depends on what kind of changes you need to make.
Okay.
Simple things like updating your beneficiary information
Right.
or payment method
Uh-huh.
are usually administrative and don't require new underwriting.
But what if I want to increase my coverage or add a rider? Do I have to go through the whole underwriting process again?
Yes.
Okay.
Any changes that affect the risk assessment for the insurance company
Mhm.
will likely require some level of underwriting.
Okay, that's fair.
Huh.
But I've heard some horror stories about agents pressuring people to replace their policies with new ones
Right.
that aren't necessarily in their best interest. What's the deal with that?
Those unethical practices are called churning and twisting.
Okay.
Unfortunately, some agents prioritize their own commissions
Right.
over their clients' needs.
Right.
They might try to convince you to replace your existing policy with a new one,
Yeah.
even if it doesn't make financial sense for you.
So it's like they're churning through policies
Yeah,
just to generate more commissions for themselves.
exactly. And twisting often involves misrepresenting the features
Right.
or benefits of a new policy
Oh,
to make it seem more appealing than your existing coverage.
that sounds shady. What can I do to protect myself from those practices?
The best defense is knowledge and a healthy dose of skepticism.
Okay.
If an agent is pushing you to replace a policy,
Mm-hmm.
ask a lot of questions and get a second opinion from a trusted advisor
Okay.
if you have any doubts.
Okay, so trust my gut and don't be afraid to seek advice from someone I know has my best interests at heart.
Yeah,
But what if I genuinely need to replace my policy?
right.
What are the key things to remember?
Full disclosure is essential. Be honest with the new insurance company about your existing coverage
Right.
and any reasons for replacing it. And most importantly, never cancel your old policy
Right.
until the new one is in force.
That's a great point. I wouldn't want to end up with a gap in coverage just because I rushed the process.
Exactly.
And if you do decide to cancel a policy altogether, always do it in writing.
Yes.
This creates a clear paper trail and helps avoid any confusion down the road.
Good advice.
Now, let's talk about the part of life insurance that no one really wants to think about. The claims process.
Right.
What happens when a claim needs to be filed?
It can be a stressful time, but knowing what to expect can make things a little easier.
Yeah.
The first step is to contact the insurance company
Right.
or your agent as soon as possible
Yeah.
after the death of the life insured.
And what happens next? Do they just hand over a big check?
Not quite. They'll need to verify the death
Okay.
and gather some information about the policy and the beneficiary.
What kind of information?
Things like the policy number,
Okay.
the death certificate,
Hmm.
and the beneficiary's contact information.
Right.
And depending on the type of policy and the circumstances of the death, they might require additional documentation.
So it's important to keep all that policy information organized and accessible just in case the worst happens.
Absolutely. And remember, accuracy is key.
Okay.
Providing complete and truthful information will help ensure a smooth and timely claims process.
Okay, so honesty is important throughout the entire life insurance journey, from the initial application to the claims process. But are there any other factors that can affect the death benefit payout?
Yes, there are a few things
Okay.
that could reduce the payout.
Okay.
For example, if the life insured misstated their age on the application,
Right.
the death benefit might be adjusted to
Ah.
reflect the correct age.
So no trying to shave a few years off.
Exactly.
Okay.
And if there are any outstanding loans against the policy,
Right.
those will be deducted from the death benefit.
Makes sense.
Hmm.
Anything else to watch out for?
Unpaid premiums can also reduce the payout.
Okay.
If the life insured missed premium payments
Right.
before their death,
Yeah.
the outstanding amount might be deducted from the death benefit.
Okay, so staying on top of those premium payments is crucial.
It definitely is. And that brings us to the end of our deep dive into life insurance.
Wow, we've covered a lot of ground. From risk management and policy types to underwriting, taxes, and the claims process, it's clear that life insurance is much more than just a simple death benefit.
It's a powerful financial tool that can be customized to fit your individual needs and goals. And as you've seen, it's not a set it and forget it type of purchase.
Right.
Regular reviews, open communication with your agent, and a willingness to adapt to life's changes are essential for making the most of this valuable protection.
So knowing all of this, what kind of policy do you think would be best for your situation? How would you use the knowledge about riders and supplementary benefits to create a truly personalized plan? This deep dive was just the starting point. There's a whole world of planning and possibilities to explore.
That's right. This information is meant to empower you to make informed decisions. Remember, knowledge is power, especially when it comes to protecting yourself and your loved ones.
Thanks for joining us on this deep dive into life insurance. We'll be back next time with another fascinating topic, ready to break down complex information and help you make sense of it all. Until then, keep learning, keep asking questions, and keep diving deep.